Have you ever wondered how investors measure the amount of debt used to finance assets? Let's break down the leverage ratio. At its core, leverage is just another word for borrowed money. It is a tool that can amplify both gains and risks. The simplest version of this metric is the debt-to-equity ratio, which divides total liabilities by the owner's equity in the business. Investors look at these ratios to understand if a company is relying too heavily on borrowed money to grow its operations. Choosing between low and high leverage is a trade-off between the desire for rapid growth and the need for financial stability. As the ratio climbs, so does the risk of default, especially if interest rates rise or revenues take a sudden dip. Always remember that while leverage can make a small investment look like a big success, it works exactly the same way in reverse. Thanks for watching. Understanding financial ratios is a key step in building your investment knowledge. See you next time.